When the stock market's down, emotions can be high. It can lead to emotions like worry or concern in regards to your financial accounts or your financial future. I felt there was no better time than the present to remind ourselves of some good investment fundamentals, or I'll say themes, that we've seen. And today we've got 10 of them, and we're going to relate each of these 10 to you, to your plan, to your strategy, to help you stay focused on the long term and not let short-term emotions potentially ruin your long-term results or your retirement.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of the Your Life, Your Money podcast. I'm your host, Scott Searins, and I felt today there's no better time than the present to remind ourselves of some good investment fundamentals, or I'll say themes, that we see in the market. And the reason being is because I understand right now emotions might be high. The stock market's down year to date. Month by month, the stock market has been falling, which can make our emotions rise. Sometimes it brings on the emotions of being scared. Sometimes it's being concerned about account values being down, and what does that mean to your retirement or to your future. For some folks, with the stock market being down, it can bring on that emotion of worry. Here's the thing, investing is not easy. And I want to go over these themes today that we've seen throughout history in the market. We're actually going to talk about, it's Bob Farrell's 10 market rules to remember. And again, there's no such thing as a hard and fast market rules. We're going to call them themes. But we're going to talk about these today to help you focus on logic versus emotion. And if you have a plan and if you have a strategy in place, why to focus on that plan and strategy and not let short-term perspective potentially ruin your long-term results. Before we dive in, first off, if you're finding value and benefit in the podcast, subscribe on your favorite podcast player. That way you get notified as we continue to come out with new podcasts each and every week. Also, one of my goals is to continue to help people just like you live life today and be financially confident about their tomorrow. If there is someone that you feel, and just think maybe one person, if there's one person that you feel could value this podcast, if they could get benefit from these episodes, do me a favor, recommend the podcast to them. Recommend that they just take a listen. And our goal, my goal, is to help people, again, continuously be confident, financially confident about their future. And the way to do that is to continue to build knowledge, gain information, which helps us build that confidence in our future. So do me a favor, recommend it to one person. Our goal is to continue to build the podcast and help many people just like you. All right. Let's dive in. Let's talk about Bob Farrell's 10 market rules to remember. Now, first off, as I mentioned earlier, rules, these aren't meant to be hard and fast rules, and there's always exceptions to the rules. And my compliance department would love for me to remind you that past performance is not indicative of future results. So while history never repeats itself, it does rhyme very closely. And these are some of the themes that we've seen over time, or that Bob has seen over time, but themes that I've read about and seen as well. And who is Bob Farrell, and why are we using, his 10 market rules to remember? We'll call them themes today. But Bob had spent decades as the head of research at Merrill Lynch, establishing himself as one of the leading market analysts on Wall Street. So in the 70s, became a technical analyst. He's seen market conditions in the 70s and the 80s and the 90s, etc. So he's seen the ups, the downs, the corrections, the crashes, and these are the 10 themes that he's seen in the market over time. And as I read through these, I felt, boy, these would be great reminders for you of why, if you have a plan and a strategy in place, that you want to stay invested. Don't let emotions take over. Don't let that short-term perspective ruin the long-term results. Now, I'm going to link to all of these themes. I'm going to link to all of this. You can, if you want to read more about Bob Farrell, you can go to lifemoneyshow.com, and there will be a link in the show notes. Again, that's lifemoneyshow.com. There will be a link in the show notes that you can click on, and if you want to read through more detail on this, you can. But here's what I'm going to do. I'm going to take each one of these, and I'm going to help relate it to us. Because you might already be thinking, wait a second, this guy's a technical analyst. This is going to be some technical data. We're going to take these, we're going to relate them to ourselves, relate them to our plan of what this means to us and why we should stay focused on our plan and focused on our investment strategy. Okay, here we go. Number 1, markets return to the mean over time. Again, that says markets return to the mean over time, the mean meaning the average. Here's a little clip, and all this is from Investopedia. It says, whether they face extreme optimism or pessimism, markets eventually revert to saner long-term valuation levels. What does this mean to us? How can we even relate to this? I want you to think about driving, and what does your car get from a miles per gallon standpoint, right? We're all focused right now on fuel and fuel efficiency with gas prices being so high. And I'm guessing you've probably looked recently to go, okay, my car gets 20 miles per gallon, or I'm going to go buy a car that gets 30 miles per gallon. Recently, my girlfriend and I, we took a trip up to Wisconsin, and I was watching the miles per gallon that we got on the trip. Now, typically, my truck gets 19 to 22 miles per gallon. That is the average over time based on my driving conditions of where I go to work, being on the highway. That's my average over time based on those driving conditions. Now, as we're on the trip, right, sometimes we're going down a hill, we take our foot off the accelerator, and I'm watching the dashboard, and that the gauge shoots up, and we're getting 30 to 35 miles per gallon. But sometimes we're going up the hill, and next thing you know, we're getting 5 miles per gallon. But if you look at the mean over time, or that average over time, and ever since I've owned the truck, it's always 19 to 22. That's what it's gotten. So that's what this first theme is that no matter the way ups or the way downs, right, the market always reverts to the mean over time. So based on an article here from Investopedia, I'll link to this in the show notes. It says stocks over time it just says from way back, right, has, and I'll link to this in the show notes so you can get the statistic, stocks have averaged 10.49%. The S&P 500 has averaged 10.49%. Again, the S&P is not an index that you can invest in. It measures the valuation of the 500 largest stocks in the United States. So what does that mean? Well, hey, for last few years, right, or over the last 10 years, we have seen multiple years where the returns or the fuel miles per gallon, right, the fuel efficiency has been way higher than that, right? So that was like when I was driving downhill and I was getting 30 to 40 miles per gallon. We've seen returns that have been way higher than the average. That's where we also see days like today or months like we've seen and years like we've seen so far where the returns will also be below average. Does it mean that they'll stay there? Again, history is, not indicative of future results, but this first theme that we've seen over time is that markets revert, meaning go back to their average. So just because that historical average might have been 10.49%, I'm certain if we look through, we might find a year where it was like that, but it was never exactly that number. We're going to find numbers that were higher than that, and we're going to find numbers that were lower than that. But just like where my truck always goes back to its average from the long-term perspective, right, that long trip perspective, the market has reverted to its mean over time. So what does this mean to us? Well, if you're building a plan, first off, know that markets are going to go up and they're going to go down. And we've got to look at historical averages to help build that plan. Also, don't get too excited that when we see years, if the market returns 30%, that's what we should build a plan on. Remember that markets will revert to the mean, revert to that long-term average. So depending on how you're constructing your portfolio of stocks and bonds and alternatives, you have to look at what those long-term averages are and construct your portfolio based upon that. And then look at conditions to say, hey, do we see the next 10 years being a little bit higher than those long-term averages, a little bit lower than those long-term averages? But I wouldn't make big jumps based on current market conditions. I wouldn't look at today and go, boy, the markets are never going to return anything again. And I wouldn't look at the last 2 years and go, we're going to get 30% every year. Again, we revert back to the mean and back to that average when building a plan. Okay, number 2. Excess leads to opposite excess. Boy, this was a really good one here. Excess leads to opposite excess, meaning we have to have patience. I'm going to say ignore the volatility. Here's how I'm going to relate this to us. Imagine that you have a spring sitting on a table or a desk in front of you, and a spring has its normal state, right? It's not fully compressed. It's not like super stretched out into one string. A spring has like its normal state. It's going to sit a certain height. Consider that normal state average returns. Okay, that normal state of that spring is average returns. Well, if you were to take and compress that spring, right? Look at that as a down market. We're going to compress that spring. It doesn't stay there. It bounces back up to normal. But sometimes, depending on what kind of spring you're using, it might bounce farther than that. And when it bounces farther than that, that means like, hey, we're down market, and then we're going to go past the averages. We're going to have this big potential up market or bull market. Same thing in the opposite direction. If we're to just take and stretch that spring out and we let it go, sometimes it's going to go past its normal state and go into compression a little bit. That's what they're talking about here. Excess leads to opposite excess. Excess on the highs can lead to opposite excess in the lows. Plus 30% could potentially lead to minus 20%. Minus 20% could potentially lead to plus 30%. But again, back to number 1, markets revert to their mean. Markets revert to their averages. Then number 3 here is excesses are never permanent. I'm going to read you from the article here. It says, whether you're riding market lows, which represent buying opportunities, or soaring at highs so they can make money by selling, don't count your chickens before they've all hatched. Those excesses are never permanent. So again, this doesn't mean just because we always have gains that are above average, that those above average gains are going to be permanent, but also just because we have losses or below average gains, it doesn't mean that those will be permanent as well. Kind of going back to theme number 1, markets always revert back to the mean. All right, here we go. Theme number 4, market corrections don't go sideways. And here's where I'm going to just kind of take this one if you want to go in and read a little deeper on it. But markets, stock markets, aren't going to wait for you to make decisions. It's not based upon your thought process. It's not based upon you hoping it goes up or you wondering if it's going to continue to go down. It's not waiting on you to make a decision. So if you do need to make changes, you just have to do it. But again, or first I would say, is have your thought process, have your plan and your strategy in place, and make changes according to your plan and your strategy, not according to emotions. Moving on, number 5, public buys most at the top and least at the bottom. Boy, isn't this the truth? I will say the typical investor, because of the news and the media, which drives up those emotions of worry and concern, because they use words like the market is crashing and we're going to go into a recession, and they don't even know, right? Really pushes people to either sell at the bottom and lock in their losses because they've gotten worried or concerned or scared, or even on the opposite end, right? When the news and media is saying, hey, everything's great, we're in this bull market, you can't go wrong by investing, and they're telling you, where to put your money and how. That's where greed kicks in, and then that's why people are buying at the top when they feel like nothing can go wrong. I'm going to relate it to today. Well, first off here it says, the need to be a contrarian is underlined by this rule. Independent thinking always outperforms the herd mentality. I'm going to repeat that one more time. Independent thinking outperforms the herd mentality. They said always, again, we can't guarantee any sort of results, but what does that mean? It means that when everybody's running for the hills, they're getting out, they're selling, they feel like it's going to get really, really, really bad, that's where being the contrarian may pay off. Same thing at the top. When everybody's getting greedy, that's where being the contrarian may pay off. Selling high, buying low. So how do we relate this to today's market? You're thinking to yourself, gosh, but I know things are low. How do you look at things as a contrarian right now? The analogy that I've used before and that I want you to think about again of where we're at in today's market conditions is that the market is on sale. If I were to give you two stores sitting next to each other, exact same high definition TV, right? And it's store A, they're on sale compared to store B. Exact same TV, exact same specs. I'm guessing you're going to go to store A to make your purchase because it's on sale. And that's where we're at in today's market. Stocks are on sale. So look at it as a sale versus looking at it as being as losses. Currently the market's on sale. You might say, well, I don't have money to go and buy from the store while it's on sale, but you might be able to rebalance your accounts. Maybe you have other parts of your account. You're not 100% in stocks or funds that hold stocks. Maybe there's an opportunity to rebalance your accounts, take something that is up and buy what's on sale. So again, looking for the opportunities in today's market conditions. Number 6, fear and greed can be stronger than long-term resolve. Boy, do we all have to be really careful with this one, right? We were just talking about fear and greed, how fear can potentially make us sell at market bottom and lock in losses. Greed could be making us buy at market highs. And here's how I want to relate this one. You know, the real estate market right now is just really interesting. And I've read a lot of things about, when somebody is buying a home, that they're going to write a letter to the seller to try to, I'll say, stimulate their emotions to get the seller, right, to pick that buyer for their homes. And what are they doing? They're really trying to inject emotions into this deal. And this is why when it comes to investing, I really recommend separating emotion versus logic. And talking to some realtors, they said, wow, these letters really work because these buyers are injecting emotion into the process. They're making these sellers just emotionally connected to them and then choosing them for their home for the sale of their home. And so that's why we want to separate emotion versus logic, because those buyers or those sellers might not always be getting the best price because now they've made an emotional decision. And in investing, there's two major emotions. There's fear and there's greed. And that's why we want to focus on logic, not these emotions, because these emotions can drive us to do things, right, from short-term perspective that could potentially ruin long-term results. So look at where you're at right now. Think about what you're going through. Think about your plan. Think about the emotions that you're going through. And are you going through emotions? And then say, or are you focusing on the logic? Are you focusing on your plan? Are you focusing on your strategy? What's your income plan? Has that been combined with an investment strategy? Do you have your growth portion of your investments for future long-term growth? Do you have your war chest portion of your investments for short-term, as you need it, When the market's down, you've got this pool of funds not subject to a whole lot of volatility, so that way you can make your withdrawals and you can weather out the storm of a market correction. Do you have the strategy in place? If so, I just want you to take a second, think about your situation, start to separate and say, I want to focus on my strategy, I want to focus on my plan, and try to push out those emotions that could potentially ruin long-term results. All right, another theme that we've seen over time that Bob's written here in his market themes is markets are stronger when broad, weak when narrow. I'll let you go through and read about this on lifemoneyshow.com. We're going to link to it, but here's my takeaway. Being broadly diversified and using funds, owning hundreds of stocks, right, is that there are strength in numbers. There's strength in numbers. Yes, you might be looking at your funds and go, but wait a second, Scott, everything is down. My accounts are down, and I own funds, and I own funds that own lots of stocks, but why am I still down? But I would guess that if you were to go into those funds and look at the stocks in those funds, there actually might be some that are up, and there might be some that are way, 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 way down in comparison to where you're actually at. And so there's strength in numbers versus just trying to pick one stock, because that one stock could be really strong when things are good, but it could also be really bad when things are weak. And so I took away strength in numbers. Again, you can go to lifemoneyshow.com. That was number 7 and read more about it there. Here we go. Number 8. What he wrote here was bear markets have 3 stages. I'm going to read right from the article here. It says, during a bear market, prices tend to drop 20% or more. This kind of market is generally caused by weak or slowing economic activity. This is followed by what's called a sucker's rally. These rallies, which can be a result of speculation and hype, but don't last very long. Again, this is when people are seeing some of that volatility. They think the market's going up, so then they're just going to buy really quick. They're not sticking to their strategy. They're not sticking to their long-term plan. And then it says the final stage of the bear market is the torturous grind down to levels where valuations are more reasonable and a general state of depression prevails regarding investments overall. Am I saying that things are going to drop some more or go up some more? None of us have the answer to that question. So the takeaway here and how to relate this to yourself is stick to your plan, stick to your investment strategy, and don't be what Bob calls here is a sucker for these temporary and fake rallies. Okay, number 9, be mindful of experts and forecast. Wow, do I agree with this one right here? In my opinion, majority of the forecast out there and the forecasters out there are wrong. Sometimes they're right, a lot of times they're wrong. And here's the deal. Experts are just trying to predict something, right? And they know that most people aren't going to go back and check their predictions. So don't get caught up in the game of, well, this expert said that the, economy is going to be good by the end of the year. This expert said that there's going to be no recession. This expert said that there's going to be a great recession. This one said it's going to be in 2023. This one said it's going to be in 2022. If we go on the internet, we're going to find basically any sort of forecast that we want out there. And of course, we're going to align ourselves with the forecast that we want to hear. So I just say, don't get caught up in this game. Ignore the forecast, ignore these predictions. Again, stick to your plan, stick to your strategy. Number 10, and I think we can all agree with this one, bull markets are more fun than bear markets. I'm guessing he didn't have to do a lot of research to figure this one out, because I'm certain you would agree with this. We're all tired of the market going down. We can't wait for the next bull market to take off and for gains to come back into our accounts. And yes, number 10 actually was bull markets are more fun than bear markets. Folks, I hope you found these as some really interesting themes, but I hope relating it to you, relating it to your plan, relating it to where you might be today was found as helpful. And I hope you just looked at these as some great reminders. And I'm going to recap some things that I've taken away here. First off, turn off the investing news and the forecast. Most likely, they're going to be wrong. If you're looking at your accounts right now and they're down, remember this. They are down in value, but you haven't lost anything until you sell. And most likely, if you knew your actual original investment, plus all the contributions, most likely you're actually still up from all of your, investing days. If you're to look at your history of investing days. But I'm guessing you, just like myself, nobody's ever kept track of that original investment and all those contributions. So think about it that way too. If you've been investing for 10, 20, 30 years, most likely you're potentially up over that period of time. Also, having a strategy in place. Do you have an income plan? Does that income plan then lead to your investment plan of how much you've got in the growth side, the equity side of your investments, and how much you've got in the war chest or that pool of funds not subject to the same volatility as the growth side? Has the income plan led to the investment plan? And then has all of that been put together, and have you thought about your income guardrails? Knowing that if the value does fall a certain level, how much of a income reduction, again, not shutting off the faucet, just how much of a potential reduction would you need to take to make your money last? Same thing on the growth side. If and when all of this recovers, do you know when you can take increases to maximize and make the most out of your accounts as well? But having these plans in place, having a strategy in place allows you to focus on the logic and focus on these themes and focus on the long term versus focusing on the emotion that a down market causes. Last is we've been here before. I'm guessing we're going to be here again. While the reasons and the stories might be different, it's going to rhyme with what we've seen before. So while I know that current market conditions are tough, hopefully this has helped you to look at that big picture, look at that long-term picture, look at your plan versus the emotions, and focus on that plan and not let short-term perspective ruin the long-term results. I hope you found today's episode to be of value and benefit, and if so, and you'd like to hear additional episodes to help you build wealth and reduce your long-term tax picture and help you be prepared for retirement, subscribe on your favorite podcast player so that way you get notified as new episodes come out each and every week. Also, if you do me a favor and recommend the podcast to a friend, a coworker, or a neighbor, pick one person, let them know the strategies and actions that you've learned by listening to the podcast. Together, we're going to continue to help more people live life today and be financially confident about their tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.